If I look at today, India as an economy, we have foreign exchange reserves which are roughly about $720 billion. We can cover our full 12-month imports from our Forex reserve itself without selling anything to anybody. At the end of the day, economics trumps any war, right? And that's how I think some of these world leaders will move. I don't know whether it's going to be a rollback for Trump, or it's going to be a rollback for Iran, or it's going to be a rollback for Xi Jinping. But they all will come down to a point of time where economics of war may not make more sense than probably the economics of tying their resources together and probably work for the better of for everybody. If I go back about, let's say, 10 years ago, 2013 or 2012 period, that Forex reserve was just about 7 months at that point of time. What we are contemplating, if this is the tug-of-war between the two different supply chains, more and more of that shifting from our neighbor to us will probably continue to happen. We have become a fairly reliable source of raw material or finished goods across variety of supply chains, right? I don't think I'm buying anything in terms of business efficiency there. It's all driven by either tariffs or by the the concessions which are given by the government of India. But do I have a company within the same sector where their profitability and efficiencies are not driven by some of these tariffs or even the incentives which are from the government? That's what I would want to buy. I think if you look at historically, even for example, you look at 15-year, 20-year, 25-year period, that 60 basis points negative is now one of the lowest probably possible, right? Which means that today it makes a lot of sense to be in equity versus a fixed income, just looking at Nifty's valuation. If I were to draw an analogy here, it's like, the way we see in boxing, right? That when you're pushed to the corner, you should be just able to take punches, right? In a defensive position. Moment I get my chance to get out of that corner, right, I will do hook, jab and punch, right, and get out of that corner and try to score as many points as possible. All fund managers have this one guru which is common, right, which is Warren Buffett. He says that volatility is an investor's best friend, and that's how we can use this period in between.
Hey friends, I am your host Kyra Ahuja and welcome to the Fund Manager View show at Emkay Investment Managers. Over the last few years, the global economic landscape has been undergoing a gradual but important shift. What began as trade disagreements between major economies has evolved into a broader rethinking of supply chains, energy security, and the way countries approach manufacturing and industrial growth. Events across the world have highlighted how deeply interconnected production, logistics, and capital flows really are, and how quickly disruption in one part of the system can influence markets everywhere. In this environment, manufacturing has once again moved to the center of the global conversation, with countries looking to strengthen domestic capabilities, diversify supply chains, and reduce dependence on single sources of production. For investors, this raises an important question. How do these structural changes translate into long-term opportunities, and how should portfolios be positioned to benefit from them while still managing the risks that come with a more uncertain world? In our Fund Manager View series, we bring these questions to the fund manager's desk to understand how long-term strategies are being shaped in response to a changing global landscape. Joining me today is Kashyap Javeri, Head of Research and Fund Manager at Emkay Investment Managers. Kashyap has spent several years closely tracking India's corporate and sectoral landscape, with a strong focus on fundamental research and identifying long-term structural opportunities. He currently manages the ENVI strategy, where the investment approach looks at businesses benefiting from India's evolving manufacturing ecosystem, capex cycle, and the broader shift in global supply chains. At a time when geopolitical developments, energy disruptions, and changing trade dynamics are forcing economies to rethink production and sourcing, the manufacturing theme has once again come into sharp focus for investors. In today's conversation, we will discuss the market outlook, the role of manufacturing in India's growth story, how portfolios are being positioned in a higher volatility environment, and where new opportunities may be emerging across sectors. Hi Kashyap, welcome to the show at Fund Managers View at Emkay Investment Managers.
Thank you so much, Kyra, for having us today.
How are you doing today?
All great.
Kashyap, drones, missiles, and jets hovering on global markets. The war raging in the Middle East is threatening the financial stability across the world. I understand that we are no longer in the fragile economy of 2012-13.
Yes.
But still, what are your thoughts on the ongoing war in the Middle East and its impact on the Indian economy and markets?
So I think, Kyra, the best thing about history is that it gives us some roadmap about where we are going to land in a slightly medium to longer term period. Obviously, the history tells us that whenever there have been large global crises, whether they are geopolitical, whether they are financial, either ways, there is a map book which is available to tell us how this is going to map out in long to medium term. In short term, obviously, there will be a lot of volatility in the market, and like everybody's guru says, right? So all fund managers have this one guru which is common, right? Which is Warren Buffett. He says that volatility is an investor's best friend, and that's how we can use this period in between. Having said that, I think it's very critical to note that, like you mentioned, right, we are no longer that fragile economy of the previous decade, right? If I look at today, India as an economy, we have foreign exchange reserves which are roughly about $720 billion. We can cover our full 12-month imports from our Forex reserve itself without selling anything to anybody, right? If I go back about, let's say, 10 years ago, 2013 or 2012 period, that Forex reserve was just about 7 months at that point of time. What I'm trying to sort of highlight here is that there will always be risks in the market. They can be inherent to the company, they can be exogenous, they can be geopolitical, they can be financial. But as an economy today, we have now strengthened ourselves so much that we can withstand those kind of volatilities. Just to give you an example, if you look at indices like Nifty 50 or Nifty Small Cap 250 Index, the drawdowns each year, and when I say drawdown, these are maximum drawdowns in a particular calendar year. They have been coming down year after year. So if you go back in the early part of this century, let's say for example period between probably 1999 to 2010, any of this kind of geopolitical or financial black swan events would entail a correction in those indices, which would be probably 40% for the large cap indices. It could be as high as about 70% for the small cap indices. If you look at last now 10 years where we have been strengthening A, our economy, B, our financial systems, and C, our external balance, those drawdowns each year have been declining year after year. Now the crisis don't lead us to those kind of crazy drawdowns like 40%, 75%. Maybe this time, despite the war, the drawdowns may remain limited to roughly about probably 15 to 17%, which we have already seen until now, right? So obviously, there is a map book available where we have seen in the past that this volatility, if you use in your advantage, 1 year, 2 year, 3 year returns after that, black swan event are in a very high double digit number. In between volatilities, you use to build your portfolios. And the second part is that as an economy, our economic systems, our financial systems, the external balances have strengthened so much that today, for example, we might be able to withstand a shock of even $90 a barrel kind of oil for a sustained period of time. So I think I would not be unduly worried today by this geopolitical upheaval that has happened. Let's use this volatility to our advantage. And some of the data points that we obviously keep looking at every now and then as to where this is leading is that obviously there is a data available. You spoke about drones and missiles and stuff like this. That scares the hell out of me. But the point is that today you have data available as to how many attacks are happening every day on the neighboring countries, split in terms of either missiles or drones or whatever you want to call them. We have daily data in terms of how ships are operating out of the Strait of Hormuz. Today, that's the buzzword, right? Strait of Hormuz, everybody is talking about that. Today, we have data about how many flights are operating from some of these Gulf countries, right? And those are the lead indicators as to where this whole crisis is now going forward to. I think if you use that period wisely in terms of investing in some of the stocks that we really like, I think next 2 to 3 years we are going to make probably phenomenal returns from this crisis. Not to say that crises are good, but that's the sort of solid substance of the crisis.
Absolutely. Kashyap, continuing with that, fund managers are experts at exiting difficult positions.
Yes.
Right? Do you think President Trump can easily and quickly exit this war situation for us?
You have asked me a question about the most volatile stock in this world, right? Which is President Donald Trump. I would sort of try to sound a bit philosophical here. As one of the greatest philosophers of the history, Plato says, all wars are fought for money, right? Here, what we are seeing today, and probably this is my assessment, Mr. Trump's assessment might be different from what I'm trying to contemplate out here, is that today you have two supply chains which are running parallel in terms of how the fuels are used in this world, right? There is one which is fossil fuel and the one which is renewable. The fossil fuel side is controlled by the Middle Eastern countries or the USA, and the renewables are controlled by, to some extent China, because they have invested in a lot of these countries which have the reserves which are used in the renewable energy space, right? So there are two different ideologies which are fighting each other. As and when they realize that the cost of war today is much more than what they both could together make out of this whole supply chain, tug-of-war. I think that's where it will sort of end up, and you might actually see a ceasefire here without one being announced, right? Just to give an example, we have Russia-Ukraine war, which probably as of February this year completed its 4 years, right? And still today we haven't seen any ceasefire being announced. And despite that ceasefire not being announced today, that war is on the 7th page of any business newspaper, or probably last page of any entertainment newspaper, right? Ceasefire still not announced. You had crude which came down from $120 a barrel to about $60 a barrel, right? And war is still raging in that particular part of the world. So it's also quite possible that you might not actually hear about a ceasefire being announced, but it may look like a ceasefire is already there. There are countries which are now talking about a passage through the Strait of Hormuz by paying something to either party, right? At the end of the day, economics trumps any war, right? And that's how I think some of these world leaders will move. I don't know whether it's going to be a rollback for Trump, or it's going to be a rollback for Iran, or it's going to be a rollback for Xi Jinping. But they all will come down to a point of time where economics of war may not make more sense than probably the economics of tying their resources together and probably work for the better of for everybody.
Okay. Kashyap, we've been hearing a lot of countries talking about judicious use of fuels. You mentioned fuels, supply chain disruptions, etc. already. What has been the impact on the Indian economy during these 3 weeks of war?
Absolutely. So before I get into a very serious answer of that, a bit sort of a funny answer to that, this morning I came to office by an Ola cab, and at the petrol pump I didn't see any queue even for the CNG, right? Mahanagar Gas, from where I get my piped natural gas, has been sending me messages every now and then that why don't you convert your friends from a LPG cylinder to a PNG, right? So that's the fun part of the whole question. A more serious answer to that is that if you look at some of the leading data indicators for the Indian economy, even in the first 20 today it's about 23 days of this particular month has already passed, and unfortunately it's the 23rd day or 24th day of the war also. If I look at some of the leading indicators, maybe it could be RTGS and NEFT payments, it could be UPI payments, it could be the national electric toll collection, right, where people pay toll when they pass those toll nakas, whether it is the ECS debits and credits, For the first 23 days of this month, they have all grown at a fairly high double-digit number. In fact, UPI payments for the first 23 days have grown at 20% plus, right? If I look at some of the announcements which have happened in terms of automotive sales for the Gudi Padwa day, right? Pune had almost about 20% growth in terms of overall vehicle sales which happened. If I look at Mumbai particular region, we sold, including the passenger vehicles, commercial vehicles or two-wheelers, almost about 20% growth in some of those. Overall, until date, I don't think there has been much of an impact on economy either from the fuel availability point of view or from the functioning point of view. But if this sustains for a longer period of time, we will see some impact happening on some of the very energy dependent sectors. For example, if you look at ceramics, almost about 23% of the total sales goes into power and fuel, and that largely depends on either LPG or LNG, right? There is a way you can substitute some of these fuels from A to B, but that does not happen overnight, right? It takes its own sweet time to change the fuel source also. And I think in that sense, if our external affairs ministry or prime minister has been able to navigate through these difficult times very tactically, and I hope they continue to do so. Those LPG and LNG containers sort of continue arriving on our ports. I think in that sense I would believe that probably on the supply chain side we will not have any issues. The second part of this whole crisis is that some of the commodities have already seen prices shooting up, right? For example, if you look at PVC prices, PVC resin prices were at their probably multi-year low until just about couple of weeks ago. Today they have shot up by almost 50%. If I look at some of the polymer prices, they have shot up by 50%. Some of the fiber prices, they have shot up by about 50%. Eventually, the playbook in the history suggests that over a period of 4-5 months, when these countries get tired of war, they try to find a way out without telling each other that this is what I'm willing to do. As and when that happens, I think you will see a better flow of that into the supply chains. But I think today we are okay. In medium term, if it continues, then probably there will be some issues. I think over a period of medium to long term, I think it should settle out.
Okay, but having said that, the crude oil and the natural gas prices have already shot up significantly in the last 3 weeks. The last time such a war happened, which is the Russia-Ukraine war, just post the lockdown, we saw a runaway inflation for 2 years. What do you think will be its impact on the inflation in India if this war and, consequently maybe on interest rates too?
Okay. So I think you need to see this in the context of where we were coming from in that period. So I think the war between Russia and Ukraine broke out on in the last week of February 2022. The lockdowns across the world were opening up, or they had opened up somewhere in the middle of 2021 calendar year, and world over every sort of central bank worth its name except for ours, or every government except for ours, were throwing helicopter money at the consumer, right? So you had lockdowns opening up, supply chains were just opening up, and suddenly that helicopter money or every money that could have been thrown to a consumer, he was using to buy goods probably which he could not buy for previous 12 to 18 months. And which is why if you look at between February 2022 to December 2023, you had inflation which at some point of time, even our WPI probably touched even as high as about 30%, right? Input WPI. I think if you look at today, the world over global central banks have been tightening all this while. It's just a very mediocre, very minor sort of dovish monetary policy that we have seen across the world. So one part is that obviously demand is not going to shoot up as it did post-COVID. The second part of it was that the supply chains were also closed during the the lockdown, right? Today, that's not the case. So I think if supply chains open up sort of quickly once this whole geopolitical risk subsides and demand is where it is, I think inflation is not going to be a big issue for the world to handle. And in which case, I think the interest rates, as we see globally, probably will also not probably move up from where they are. I think over a period of medium to long term, I would actually see global interest rates coming down marginally as we go forward.
Okay, but the most important question investors are pondering about.
Yes.
Supply chain disruptions
Yes.
led to manufacturing realignment.
Yes.
Do you see something similar happening with energy chain disruptions too?
So one point I highlighted in my previous remarks, right, that this is actually more like a tug of war between two different supply chains, right? One which is led by the one of the largest economy in the world, and the second guy who is just about to sort of he's trying to get where the largest one is. I think some part of that shift of the supply chain has already happened. I think if like what we are contemplating, if this is the tug of war between the two different supply chains, more and more of that shifting from our neighbor to us will probably continue to happen. We have become a fairly reliable source of raw material or finished goods across variety of supply chains, right? We have done that in terms of automobiles, right? Today, probably a guy who is sitting in Mexico manufacturing a vehicle for a consumer sitting in US with some ties to Canada, he is actually looking at India as more reliable partner than probably China at this point of time. If you look at textiles, we have done the same thing in terms of global supply chains. I don't think why we should not be able to replicate the same thing in terms of many other sectors, could be including some of the capital goods equipment. It could be in renewable energy. It could be in terms of manufacturing capex that some of these countries want to do. Why can't we replicate the same thing in terms of some of the FMCG products that we manufacture? Why can't we do the same thing? Or in fact, we are doing the same thing in terms of pharmaceutical also, right? Why can't we go a step backward from that pharmaceutical to even one point down the line, which is the chemicals which are used in that particular sector? I think this shifting of supply chain will continue to happen unless we do something really, sort of miserable at the policy point of view.
Okay. Next important question. But in view of these major disruptions, how is your sectorial outlook realigned to the new global realities?
So, Kaira, when we build portfolios, I don't think we keep in the mind that there is a supply chain which is shifting from A to B, right? The way we select companies, our companies are already a part of that global supply chain on their own. Just to give you an example, if I were to buy today, probably textile stocks, just based on the fact that USA is going to reduce the tariffs to whatever 10%, 12%, 18%, eventually whatever the number comes. And then I say that there is the government of India which is going to give some incentives for them to manufacture textiles in India. I don't think I'm buying anything in terms of business efficiency there. It's all driven by either tariffs or by the the concessions which are given by the government of India. But do I have a company within the same sector where their profitability and efficiencies are not driven by some of these tariffs or even the incentives which are from the government? That's what I would want to buy, right? So I think supply chain shifting, yes, is a very important parameter here, but not the not the parameter that I would say is paramount when I look at my NV portfolio, right? The way we have named it, Emkay New Vitalized India Strategy, it's called NV, right? It's neighbors envy, our pride. And our pride can't come from the fact that there is somebody who is supporting this business. It has to stand on its own. So if you look at any of the businesses that we have bought, whether it is, and if you look at our sectoral compositions, we are heavy on auto ancillary. There are no incentives which are given by the government to that particular segment. If you look at capital goods, again, it's doing wonders on its own. Our companies are supplying gears, compressors, and you name a product and we are in this global supply chain. Our third largest exposure is a pharma and within the pharma, the CDMO segment, the contract development and manufacturing. Again, that segment is doing significantly better on its own by the chemistry that they have developed over a period of time and made names for themselves in the global supply chains. Nothing to do with either the geopolitical risk or the tariffs or the PLI schemes or the incentives. You name any kind of incentives, I don't think my companies are dependent on, and that's been our process from day one. Can I build a portfolio of 20-21 great companies which are part of the global supply chains? If let's say global supply chain disrupts, then they can do something on their own in the domestic market. Are they the best quality products available to the world from India? And those are the companies that we have invested in. And I think we will continue to be the portfolio alignment will continue to be in that fashion. I think the sector allocation, largest ones, auto ancillary, automobile, capital goods, pharma, and that followed by FMCG.
Okay, follow-up question, a dangerous one. But with the novel innovations like drones dominating war fronts, how do you see the outlook for defense manufacturing in times to come?
So I think so far as the wars are going to be popping up, probably here and there, and I don't think there is anything that can probably stop us from, as humans, we have tendency to fight with each other, right? So we can't stop that tendency at any point of time. So I think we are going to keep, these countries are going to get involved with each other. The skirmish can be like this, which continues for probably a couple of weeks, couple of months. It could be like Russia and Ukraine, which is for a couple of years. It could be like Operation Sindoor that we did, which might last only probably 10-15 days. But these products are going to be needed, world over, right? And we have made our name post that Operation Sindoor. The patriotism in me is saying this, that we have made our name on the global, defense plate, right? So I think that's gonna continue. Having said that, what we believe is there are multiple ways to play this defense theme. One, you can invest in some of the expensive names which are already available directly with defense, and I think that probably would be a mistake to do, because whenever you're buying a particular stock, you look at one, financials, but B, valuations also, right? So that's the one way to play at it. There are other ways to play at it, which is that for a particular, let's say if you're building a submarine, right? To manufacture a submarine, you need multiple components, thousands and thousands of components, maybe billions of them. And there are companies who are specializing in building those components, right? For example, a submarine will need gear. So you have somebody who can make gears. The submarine will need compressor to, compress gas or air, within that submarine. So there are compressor players which are available. There will be, somebody who will build that submarine over a period of time, right? And you have contractors which are available in that space. So idea is that yes, defense is going to be, a center focus for a lot of, let's say, the global, policies for a lot of countries. We are going to make our name there. There is absolutely no denying that anybody who is world over can make their defense fortified without having India into account. But like I said, it's whether you have a direct exposure or you have indirect exposure, which one at what point of time makes sense depends all on the valuations.
Okay. Kashyap, also many HNI investors today are looking beyond traditional diversified portfolios and exploring thematic strategies as a part of their allocation. Where do you see a manufacturing-led investing fitting with a long-term portfolio?
So let me correct you there, Kaira. It's not a thematic. Okay. So our manufacturing, or rather our strategy, which is focused on India's resurgence in the industrial segment. We are investing, like I said, there are 4 sectors which I have already sort of given you that these are the large weightages, right? But besides those large 4 weightages, there are at least about 6 odd sectors which are part of the strategy, right? A thematic is somebody who focuses only on one theme. What I'm saying is that within India's manufacturing, there are multiple themes playing out, right? One you yourself mentioned, which is defense, right? The other one which I mentioned is that we have already made our name in the supply chain in auto ancillary, right? Today, Indian companies are moving beyond auto ancillary application within, let's say, a metallurgy or a process to even non-auto applications of the same metallurgy or the process, right? Today, we have made our name in the pharma CDMO as good as or better than China, right? So there are multiple themes which are part of this strategy, not focusing on one. At any point of time, anything doing good, bad, ugly, we have a flexibility to maneuver amongst them. Having said that, when I look at a company, I'm looking at investing in that company for multiple years, and I want a small cap company to become a mid cap company to a large cap company. And I'm not going to leave my company midway, just because there is a theme which has now come into picture, right? So I think thematics, in a sense, are good when the sun is shining, but not necessarily work for you when there is a sunset at some point of time and you don't realize, right? So we are playing multiple themes within the same strategy, and then it's as good as any other strategy in terms of playing multiple themes.
Right. So you're saying NV is very well diversified.
Absolutely.
When it comes to sectors, and it's not specifically a thematic fund, right? Perfect, Kashyap. But Nifty 50.
There are a lot of buts in your question, so.
Nifty 50 has been at the same level since the last 2 years.
Yes.
We have seen both time and value correction. Are the valuations now making sense after looking at the correction that has happened recently?
So the trickiest question is now coming towards the later part of the interview, right? If you look at Nifty 50 today, probably a level of, I don't know what it is right now, but maybe about 23,000 something or something like that. I think it's almost about 15, 16 odd months that we have seen that kind of level just hovering there.
Right.
But within the same period of time, if you look at some of our strategies, including NV, we have delivered returns which are significantly higher than the benchmark. So I would say, despite so we as an investors, rather not we, but sort of layman investors have a knack of looking at indices and saying that market is probably good or bad today. But beneath those indices are 50 stocks, right? Beneath NSE 500 there are 500 stocks. Within small cap 250 there are 250 stocks, and not all 250 are doing bad, right? Within those 250 stocks there are some which are doing good, and if you focus your portfolio on something that is going to do better over let's say next 24 or 36 months period, there is a possibility that you will generate return. Having said that, if I look at particularly even indices as of today, if we were to focus only on the indices, which is very narrow in my opinion, Nifty 50 today is quoting at about 20 times trading 12-month multiple. I think ballpark 20 and a half. I think it should be about that. That should earn about 5% earnings yield, right? It's simple. 100 divided by PE will give you an earning yield on the stock. So we are making about 5% earning yield there. Today, if I look at 12 months GSEC yield, that's roughly about 5.6%, right? Which means if you were to be in equity today, you are earning only 60 basis points lower than a fixed income, risk-free, instrument. I think if you look at historically, even for example, you look at 15-year, 20-year, 25-year period, that 60 basis points negative is now one of the lowest probably possible, right? Which means that today it makes a lot of sense to be in equity versus a fixed income, just looking at Nifty's valuation. Within the overall market valuations, I think you will find a lot of stocks which are even today available at a very great price. During this 14-month period, actually I can vouch for this because we have added 3 stocks in our portfolio within this 16 months, and they have actually been the best performer in the stock in our NV portfolio. So my idea is that just don't look at the indices and valuations. Yes, they have corrected a lot, time-wise, value-wise, they are very comfortable. But within even the whole universe, it's not today, even today, difficult to find stocks which will make you money.
Absolutely. So we all know that NV strategy has been a complete rock star performer for the investors, and you've been a star fund manager too. But do you think that there is more alpha coming, your way, given the new alignments in energy and energy distribution chains?
So, just to give you ballpark numbers, so last 12 months, we have generated returns on TWRR basis, which is roughly about 9.8%, versus benchmark, which is just about flattish or about 1% kind of a return. So there is a significant about almost 800-900 basis points outperformance as of today. If I look at 2-year, again, we have generated returns which are roughly about 12%, right. Benchmark at probably about 6.5%, so about 600 basis points. I think if we continue with the process that we have, which is to select companies which are best in their sectors, available at the right price. I spoke about this even in case of defense, right? That I'm saying that defense is going to be one of the great themes going forward. But if I buy at the right price, it will make money for my client. If we continue that process, which is selection of stocks through our proprietary equal model, where we assess the quality of the promoter, we assess the quality of the business, we assess the quality of the fact that any of these kind of exogenous pressures will impact the businesses that I own the least amongst the whole observable universe. I think alpha will continue to flow even in future. It's a portfolio approach, right? So at some point of time, out of 21 stocks, 12 will do good, probably 8 will not. Next year, some of those 12 will do good, 8 probably will not. So far as my 2/3 or more than 2/3 of my portfolio continues to do well versus the market, I think I will continue to generate alpha for our clients.
Absolutely. So despite the significant turbulence that we have
Yes.
seen in the market in the last 6 months, I think you have done very well here.
Yes.
And I think there has been an outperformance of upwards of 9% versus
Yes.
the benchmark. So what has really worked in favor of your strategy?
So I spoke about the process, right? So the process selected some of these stocks, and that has done. So we have made maximum of our money in previous 12 months. I'll tell you. So that secret sauce is now coming, right? We have made a significant amount of money on CDMO. That's one part where we have done significant amount of gains. The second part is auto ancillary. That's where we have made phenomenal gains. The third part is a part of FMCG. I mean, today if you speak to anybody, FMCG is not something that people want to own. But even in FMCG, we have made decent amount of money, primarily because our stock selection criteria was slightly different versus a normal consumer-driven businesses that a lot of people look at, right? So these are three spaces where we have made a significant amount of our money. The other part of alpha has come from actually cap goods / infrastructure. So that's one sector, despite the fact that capex cycle, if you speak to anybody in the market, they would say, the capex cycle in this country remains as elusive as, probably ever. But we have a slightly different view over there. We believe that capex cycle picked up dramatically post-COVID. It has never slowed down even in past 12 to 24 months. And if we are going to continue to make our space in the global supply chain, that capital goods spending will continue for next at least about 24 to 36 months. So CDMO, auto ancillary, capital goods, and a part of FMCG.
Kashyap, ace investors like Stanley Druckenmiller often talks about protecting the ability to compound over long periods. When you manage your portfolios today, how much of your thinking is about avoiding big mistakes rather than just chasing returns?
So if you look at the portfolio performance across, let's say, some of the star fund managers, 60-70% of the job is done when you avoid a mistake, right? So today, let's say if I'm building a portfolio of 21 stocks, if I get even probably 10% of those names, which is let's say 2-3 stocks, which probably are not the companies that ideally I should have invested in, and I lose clients' money. For example, the stock drawdown is as high as about, let's say, 60-70%. I have assigned 15% weights there, and the stock goes down by 50%. A simple math says that I will lose 7.5% of my returns there, right? The idea is to avoid those pitfalls. And when you do that, your ability to compound over a period of time materially goes up, right? Because I'm not taking that 7.5% hit, which my probably next best fund manager would have taken. If I were to draw an analogy here, it's like, the way we see in boxing, right? That when you're pushed to the corner, you should be just able to take punches, right? In a defensive position. Moment I get my chance to get out of that corner, right? I will do hook, jab and punch, right? And get out of that corner and try to score as many points as possible. So when I look at the portfolio through our equal process, Emkay quality framework, the idea is that we avoid those pitfalls, avoid those mistakes. The stocks don't contribute a fairly large negative alpha to the overall portfolio, which means the portfolio individual stock wise has to work only as much. So I think avoiding mistakes like those will definitely help you to generate better alpha over a period of time, better than even benchmark or probably any other strategies that are available to your investors. Avoiding those mistakes is probably 60-70% of the job. The other 30-40% of the job is to create alpha through the other names, and I think that should help you score a fairly good deal with the clients.
Got it. Thank you so much, Kashyap, for being on the show today.
Thank you so much, Kaira.
This has been a very insightful conversation, especially at a time when global markets are going through a phase of realignment and investors are having to think more carefully about long-term growth. Where will long-term growth come from? As we discussed, the renewed focus on supply chains, domestic manufacturing, and industrial capability is not just a short-term reaction to recent events, but potentially a structural shift that could shape investment opportunities for years to come. For investors, this makes the role of research-driven strategies even more important. Understanding which business can truly benefit from these changes and how to stay invested with discipline even when the markets move through phases of uncertainty. It was also interesting to hear how thematic investing, when approached with the right framework, can complement long-term portfolios. particularly for investors looking to participate in emerging trends without losing the sight of risk management. Kashyap, thank you for sharing your perspective and giving us a deeper look into how you are thinking about the manufacturing opportunity and positioning portfolios in this evolving environment.